Okay, a little technical difficulty, but we're here. We're back with St. Louis Home Chat with Glen Calvin at Cornerstone Mortgage. So Glen was just telling us about rates. We were asking him about how rates are doing, and Glen was saying, hey, rates are great right now. But where do you think rates are headed, Glen?
I think with the way the economy is growing and home prices getting higher, I think we're going to see rates move up slightly. That said, I think this is a tremendous time to refinance or to buy a house, because those who are going to wait for things to get better are going to end up paying a higher interest rate and are going to see home prices getting much more expensive.
Wow, okay. So he brought up a good point about home prices rising, interest rates rising. So, and he was talking about refinancing. So let's just talk about refinancing for a little bit. So maybe you already have a loan and you're wondering, should I refinance right now? And so I'm going to ask Glen, what's a great rule of thumb on the spread between your present interest rate, the new interest rate, and how does private mortgage insurance play into when you're figuring out whether to refinance or not?
Okay, I'll start with the last part of that question and say that private mortgage insurance is something that anybody that doesn't put 20% down on a loan has to pay. Now, there's a bunch of different ways you can pay it. There's lender-paid mortgage insurance, there's monthly mortgage insurance, there's split premiums. But once you get in a house and you're paying private mortgage insurance, you want to get out of it as quickly as possible. And that's one of the silver linings in seeing the house prices appreciate over the last few years. So I think now there are a lot of people that bought a house 5 or 6 years ago that now have the equity in their home to get out of the PMI. And a great way to start the process is just to give me a call or give your lender a call. They'll do an analysis. They're going to look at your credit report. They're going to look at some comparable sales. They're going to find out if it's worthy to get out of that PMI or not. A lot of times you can sacrifice going to a slightly higher rate to get out of the PMI and still drop your payment. And in certain cases, we've seen people go from a 30-year amortization to a 15 or 20, eliminate their PMI, keep the rates similar, and keep their payment the same.
Wow, that's awesome. So he's talking there a little bit about credit too. So I want to ask Glen a few questions about credit. Obviously, loans are credit is important when you're getting a loan. So let's just say I'm a first-time home buyer and I really don't have much credit. First of all, how do I build credit?
It's a great question. The best way, the credit score, what that's telling you is how responsibly that you use and maintain credit. And without any credit, it's very difficult to get a credit score and to build a higher score. So you want to get a credit card. You want to use it responsibly. You want to keep that balance under 10%. You want to pay it off as the bills come in. You want to go out and maybe purchase an installment loan, of furniture, a car. Don't by any means overextend yourself, but get credit and use credit. That's the way to build a score.
Okay, so isn't there a little trick too if you're a young person? Can you get onto one of your parents' credit cards or onto one of their installment loans in order to build your credit? Does that help?
You can. You can have a parent or a sibling add you as an authorized user, and a lot of times that will increase and help your credit score. But you have to be careful on that because not all people use credit wisely, and I've seen instances where the parents might not maintain their credit the way the children thought. It can be tricky, but it can be a useful tool. It's something certainly to look into.
Okay, great. So what affects your credit? Does the amount of debt that you have, the amount of debt, maybe your car payment's really high, you've got credit cards and maybe they're maxed out. Exactly what affects credit? Tell us about that.
So what the credit score is doing is looking at your history of using credit. So if you have a poor history of using credit and you're paying your bills greater than 30 days late, that's going to have a really, really hard negative effect on your score. So the number one thing you can do is to pay your bills on time and pay within 30 days. The second thing that can pull the credit score down are high balances on your credit cards. So if you have a credit card and the limit is say $2,000 and you have a balance of $1,900, that's going to have a very negative effect on your credit score. But a lot of times we see people that can take some cash that they have, reduce those balances on those credit scores and get an immediate boost to their credit history.
So what's a good percentage when you're talking about your credit limit on a credit card versus what the percent of the balance you're carrying of that?
You really want to keep that below 30%, 10% is optimal.
Oh wow, 30%, 10%, you hear that? Wow, that's crazy. So, and I know that Glen has some great credit repairmen. So let's say I've gotten myself into trouble and my credit score is not so hot. How do I get it back up to where it needs to be? Is there somebody who can help me out with that?
Well, first of all, I like to look at it myself because a lot of times, just the 27 years I've been doing this, I'm able to give you some advice on how to do that and look at and go over and see that we can do just on our own. If not, I've got a couple great resources that I can point you in direction. And these are people that charge a fee, but they can help you with writing letters to the credit bureau, making sure that there's no inaccuracies on your report, and doing the work that you may be too busy to do on your own.
Yeah, sometimes even negotiating with a debtor.
Yes.
Right?
Yes.
Get a loan paid off or get it settled, get it off, because you're disputing it and yet it's hurting your credit because it's not resolved, and they can help bring resolution to that, right?
We do it all the time.
Okay.
The main thing as far as a credit is not to stick your head in the sand. Get a copy of your credit report, find out exactly where you're at, and then get a plan to improve it, and work with somebody like me that can give you the guidance and the experience to get it up there to where you can buy a home.
Okay, so I want to go look for a home, just starting out. What's the first thing I do?
Really, you want to get a hold of a lender and get approval, pre-approval. Most people won't even let you in to look at a home, or agents don't want to show homes without somebody that's gotten with a lender and gotten a pre-approval. Here at Cornerstone, we like to not only get a credit report and ask you all the questions on the loan application, but we like to get copies of your pay stubs, W-2s, and actually process that file and get an actual approval before you even go out and write a contract. What that pre-approval process also does is it lets you know about the closing costs. It lets you know what the payment's going to be, what are the expectations on the down payment. All those things can be covered in a simple interview with a qualified loan officer.
Oh, there you go. So if you don't have a price range established, then you don't know what to go look for. And if you look above and beyond your price range, you're never really happy with what's in your price range. So it's really important that your first stop be a good lender, like Glen. So contact your realtor so they can refer you to good lenders, and that's what we have Glen Calvin for. He is awesome at this, and when he gives a pre-approval, I know we are good to go. And that's really important. Sometimes people get pre-approvals and really they're not worth the paper they're written on. And so it's really important that you use somebody really, really competent. Okay, so let's say I have a 30-year mortgage and I want to turn it into a 15-year mortgage. Do I have to refinance to do that?
You do not. You can make, almost all loans now don't have prepayment penalties, so you can just add the extra principal, calculate what a 15-year amortization would be, and add that extra payment to it and pay the loan down in 15 years. However, by refinancing to the 15-year mortgage, oftentimes you can reduce that interest rate because the interest rates on 15-year fixed rate mortgages are extremely low now.
Extremely low. How low are they? Let's just say for a $150,000 loan.
You're looking at a range, and it changes day to day, and it can be affected by the credit score, but I would say between 3.25 and 3.5% for a conventional 15-year fixed rate.
Wow, that is really low. So if you're thinking about refinancing, that would be an awesome conversation to be having with Glenn right now. Now, let's say I want to go buy a home, but I want to avoid private mortgage insurance. Is there any way to avoid it? Private mortgage insurance, by the way, why don't you tell us what it is first?
Well, we touched on that a little bit earlier, and private mortgage insurance allows you to buy a home without putting 20% down. And the people in the private mortgage industry are proud of the work they do, and I know I hear stuff on the radio, the evil PMI, but really it has allowed a whole group of people to enter in the home purchasing market who didn't have to sit around and wait until they had saved 20% down. Private mortgage insurance ensures the lender that if you default, that loan gets paid down to below 80% to give them the security to make that loan. There really are no ways to avoid it. It can be financed on top of the loan. It can be paid into the interest rate spread. So you may be able to, a going rate on a 30-year fixed rate might be 4%, but a lender could offer you a rate at 4.25%, and he would pay that PMI for you, so it wouldn't be in the payment as a monthly dollar amount.
Oh, it's called lender paid.
Most
PMI.
commonly, we see the PMI paid on a monthly basis, and right now, with the homes appreciating, I'm really not that big of a opponent of the monthly PMI. I don't think it's a bad option, because after you can prove to that lender that you have equity in the home, by law, they have to remove that PMI. So you're not paying that higher interest rate as long as you have the loan. You're actually paying a lower interest rate with the PMI for a short period of time. The thing about PMI, every case is going to be a little bit different. So again, I say get with somebody that you can trust, that knows what they're doing, that can give you the options and can get you the house payment that you can afford and that you're comfortable with.
There you go. So when it comes to PMI, if you're young and you're starting out and you know your income's going to grow, and you know that the house prices are going up, or you're buying something that you can fix up, How long do you have to be in the house before you can get rid of the PMI?
12 months. You need
12
to be in there
months.
12 months.
Okay. And is that just to get rid of it with your present lender, or can you refinance before that?
You can do both. You can refinance to get out of it at any time, because all our loans have no prepayment penalty, as do most of them. Or you can petition the lender after a year and show them through a qualified appraisal that you have the equity in the house.
Okay, that's awesome. All right, so how hard is it to get a loan these days if I'm self-employed?
If you're self-employed, it is a little bit more difficult in that we're going to look at your income, and we have to spend our time to determine how much of your income we can document through your tax returns.
Okay.
Years ago, we had the stated income for self-employed people, because self-employed people are able to shelter some of their income and have expenses that are legitimate that they can write off. So we have to take that into account. So as long as you have a history of doing what you're doing, and we prefer to have 2-year history, we can look at your income as self-employed, find out what that number is, and then give you a pre-approval based on that.
Okay, so when you make a loan, you guys sell your loans, right? You initiate the loan, then you sell it to somebody, right? Who do you sell it
Exactly.
to?
Cornerstone, I'm very fortunate, one of the few brokers in town that actually sells a large portion of its loan directly to Fannie Mae and Ginnie Mae. So we service about half of our loans here at Cornerstone. The other half, we sell them off to somebody else. So about half of the people that get a loan at Cornerstone, they actually pay their mortgage back through Cornerstone.
All right, so there you go. Not everybody can sell directly to them, and that's why there's probably better rates here, aren't there?
Better rates, and I'd say a more convenient and a much more efficient operation.
Yeah, so we only use certain kinds of lenders at the Dillmon Group here, and one of our qualifications is the lender be local, and the lender have all the processing right in-house. When it comes to the person who takes your loan application, like Glen, and then someone processes it, and then somebody approves it or underwrites it, we call them the underwriter. And so we like it that here at Cornerstone, that's all in-house. It's all right here. So if there's a question or an issue, Glen can just walk over to that underwriter's desk and ask them a question, give them a piece of paper they've been looking for, whatever it is, so that things get done on time, things get done right, and we're not sitting on an underwriter's desk in Timbuktu in some other state someplace, hoping and praying that today we might get an answer. So that's one of our requirements. The second requirement is fees. Lenders charge fees for a loan. That's how it works. You get appraisal, credit report, flood letters, and underwriting and processing fees. And there are a lot of lenders who charge a lot of money to initiate a loan. But here in Cornerstone, I would have to say you probably have one of the lowest closing costs of a lender that I know of.
Well, I appreciate that, and that's one of our things, to try and keep that cost low so that your money for the down payment can be used to keep your payment low. When you talk about the processing underwriter, our underwriters here at Cornerstone, and I'm fortunate in this office, all 3 of my underwriters here were at one time, all 3 of my processors were at one time underwriters. So we're very fortunate,
Wow.
and I'm really impressed with Cornerstone and their ability to make loans happen, to sit down and strategize, and to find a way to make a loan instead of find a way not to make a loan.
That's awesome. So if you need to refinance, if you're just starting out looking for a home, or if you're not really sure what your credit is, hey, I don't know where my credit is, I think I did have a problem, I might have paid something late, I don't really know where I stand, give Glen a call. Just sit down, you can talk to him on the phone, come in and sit with him. Glen will even come to you. He's a great guy. So he's got such a big span of experience that he will be able to direct you to the right person or direct you to the right plan. Getting a plan, that's what you need. Get on the road to home buying, because people who own homes, their net worth far outweighs anyone who does not own a home. So thank you for listening today to St. Louis Home Chat. Again, I'm your host, Angela Dillmon at the Dillmon Group, where our average sale price is 101.51% of the asking price. Nobody gets you more money than we do. Now, I want to give you Glen's contact information. Glen, give us your phone number and your email.
Sure. The email is gcalvin@cornerstonemortgage.com, and my phone number is 314-249-6861, and you can find me on Facebook on the Calvin team.
The Calvin team, there you have it. Glen's got a great team here. Thanks for watching. Have a great day, and we'll talk to you next week.